London, 2008. It is a grey, drizzling morning in Canary Wharf, the kind that soaks into the concrete bones of the banking district. Inside the glass towers, the air is conditioned to a crisp 68 degrees. On the fourth floor of a major bank, a junior employee, let's call him the submitter, sits before a Bloomberg terminal. He is not a master of the universe. He is not a CEO. He is a mid-level functionary with a lukewarm coffee and a half-eaten bagel. At 11 a.m. sharp, he has to answer a question. A question that will determine the price of $350 trillion worth of global assets. The question is simple. At what rate could you borrow money today? If he types 4.50%, a pension fund in Ohio stays solvent. If he types 4.55%, a municipality in Italy goes bankrupt. He looks at his screen. He looks at a chat window blinking in the corner. A trader, sitting 3 desks away, has sent him a message. "Mate, I need it low today. Do me a favour?" The submitter hesitates. Then, he types the lower number. He hits enter, and just like that, he has reached into the pockets of millions of people he will never meet, and taken a little bit of their future. This is not a robbery with a gun. It is a robbery with a spreadsheet. This is the story of LIBOR. Most people think the price of money is set by the invisible hand of the market. They believe in the sanctity of supply and demand. You are here because you suspect that is a lie. You are right. The financial system is not a machine. It is a club. And for a long time, the entry fee to that club was knowing which number was real and which number was a fiction. We are going to deconstruct the greatest heist in financial history, not by looking at charts, but by looking at the text messages of the men who pulled it off. If you want to understand how the plumbing of the global economy actually works, and how it leaks, make sure you are subscribed. Join the few who understand the rigging. Let's open the books. To understand the crime, you have to understand the crime scene. But the scene isn't a dark alley. It is the polished mahogany boardroom of the British Bankers Association in the 1980s. Picture a room full of men in pinstripe suits, thick knots in their ties, cigarette smoke hanging in the air. They needed a benchmark. As global finance exploded, banks needed a standard price for lending to each other. They couldn't call every single bank in the world every time they wanted to write a loan. They needed a single number, a reference rate. So, they created LIBOR, the London Interbank Offered Rate. It wasn't an algorithm. It wasn't based on hard transaction data recorded on a blockchain. It was a poll, a survey. Every morning, a panel of 16 major banks would simply be asked to estimate their borrowing costs. It was a system built on the assumption that a banker is a gentleman, and a gentleman tells the truth. Imagine building a nuclear reactor where the safety mechanism relies entirely on a security guard promising he isn't sleepy. That was the foundation of the global credit market. It worked fine when the market was small, but by the 2000s, that gentleman's agreement was underpinning the entire world economy. Let's visualize how this survey actually worked in practice. Imagine 2 characters. One is the official, representing Thomson Reuters, who collected the data. The other is the banker, at a panel bank. The time is 10:55 a.m. The phone rings. The official. "Good morning, old chap. What's your 3-month yen rate today?" The banker. "Well, markets are a bit tight. I'd say we could borrow at 0.75%. The official. 0.75. Got it. And the 6-month? The banker. Call it 1.10. The official. Cheers! That's it. That was the science. There was no audit. The official didn't say, "Show me the receipts of the loans you took out at 0.75%. He just wrote it down. Now, scale this up. 16 banks answer this question. The top 4 answers are thrown out. The bottom 4 answers are thrown out. The middle 8 are averaged. That average becomes the official LIBOR rate for the day. At 11:30 AM, that number flashes on screens from Tokyo to New York. And the moment it flashes, interest rates on student loans in Texas, mortgages in Manchester, and derivatives in Dubai all reset. A subjective opinion becomes an objective fact. You might be thinking, if they throw out the top and bottom answers, isn't the system safe? That is the trimmed mean fallacy. It sounds robust. It is designed to stop one rogue bank from spiking the rate by submitting a crazy number, like 10% when the market is at 2%. That outlier gets trimmed. Gone! But here is the flaw. You don't need to be an outlier to rig the game. You just need to move the herd. Imagine a gymnastics competition. There are 10 judges. The highest and lowest scores are dropped. If you bribe one judge to give you a 10, his score is dropped. It changes nothing. But what if you don't ask for a 10? What if you ask 3 judges to just nudge their scores up by 0.1? They remain in the middle pack. Their scores are counted, and the average moves. This is the weakness of the trimmed mean. It protects against chaos, but it does not protect against collusion. If a cluster of banks decides to all move slightly in one direction, just a basis point or two, the trimming mechanism fails. The average shifts. And in the world of high-frequency trading, a shift of 0.01% is not a rounding error. It is a fortune. So, we have a survey-based system. We have a vulnerability in the math. But why does it matter? Because by 2008, the amount of money tied to this number was no longer just interbank loans. It was everything. The Fordham Journal of Corporate and Financial Law estimated that over $300 trillion in financial contracts were indexed to LIBOR. To put that in perspective, the entire GDP of the world is about 100 trillion. The LIBOR market was 3 times larger than the entire economic output of the human race. A 1 basis point move, that is 0.01%, on $300 trillion is $30 billion of value transfer. 30 billion. Decided by a phone call. The temptation was too great. The pile of money was too high, and the guards were too sleepy. Somewhere in London, a trader realised that he didn't need to predict the future. He just needed to buy lunch for the guy who wrote the survey. Tokyo, 2006. The trading floor of UBS. It smells of ozone, instant coffee, and sweat. The room is a cavern of monitors, flickering with the heartbeat of the global economy. In the corner sits a man named Tom Hayes. He is not your typical Wolf of Wall Street character. He doesn't wear pinstripes. He wears a sweater. He drinks hot chocolate. He is obsessed with the math. On his screen, he sees his book, a massive portfolio of derivatives denominated in Japanese yen. His position is long on interest rates. This means if interest rates go up, his P&L, profit and loss, flashes green. If they go down, it bleeds red. He stares at the number, LIBOR. It is currently fixing at 0.55%. He does the mental math. If that number ticks up to 0.56%, just 1 single basis point, his book gains $750,000. $750,000 created out of thin air, because a decimal point moved. The air conditioning hums. Hayes looks across the room. He knows the submitter for UBS is sitting right there. He knows the submitter has no skin in the game. The submitter just wants to go home. Hayes opens a chat window.
We don't have to guess what Hayes said. We have the chat logs. This is verbatim how a financial crime begins. It starts with politeness. Hayes: morning, mate. Where are you seeing the 3-month yen today? Submitter: looks flat. Maybe 0.60? Hayes: I really needed high today. I'm huge long. Can you put in 0.62? Submitter: 0.62? That's a bit above market. Hayes: it would really help me out. I'll sort you out with a drink later. Submitter: okay, I'll see what I can do. That's it. No cloak and dagger, no secret meeting in a parking garage, just a request for a favor between colleagues. The submitter types 0.62 into the system. He sends it to Thomson Reuters. To him, it's just a number. To Hayes, that favor is worth the price of a luxury house. But Hayes has a problem. One bank submitting high isn't enough. The trimmed mean will chop it off. He needs more. He needs an army. Let's pause to understand the leverage here. Why does a 0.01% move matter so much? Imagine a seesaw. On one side, you have a mouse. On the other side, you have an elephant. To balance them, you need a lever that is miles long. In the derivatives market, the notional amount is the elephant. Traders like Hayes hold contracts with face values in the billions. They don't put up billions in cash, they put up a tiny fraction. This is the lever. When you are leveraged on $1 billion of swaps, a 0.01% change in the interest rate equals a $100,000 shift in cash flow instantly. Now, imagine you have 50 billion in swaps. That tiny tick is now $5 million. The asymmetry is staggering. The effort required to move the rate is zero, just a text message. The reward is millions. The risk, at the time, seemed non-existent. There were no cameras in the chat rooms. The regulators were looking for bank robberies, not math discrepancies. Hayes realized he was holding the long end of the lever, and the world was sitting on the other side. Hayes had compromised his own bank. But that wasn't enough to guarantee the fix. The trimmed mean was still his enemy. If UBS submitted high, but Barclays, Citi and RBS submitted low, the UBS submission would be discarded as an outlier. Hayes realized he couldn't just be a trader. He had to become a conductor. He needed to coordinate the submissions of banks he didn't work for. He needed to reach inside the walls of his competitors and turn their dials too. But he couldn't just call up a trader at Barclays and ask for a favour. They were rivals. He needed a middleman, someone who talked to everyone, someone who had no allegiance to anyone but themselves. He needed the brokers. London, the height of the boom. Enter the inter-dealer brokers. These men were the grease in the gears of the city. They didn't take positions. They matched buyers with sellers. Their offices were loud, testosterone-fueled locker rooms where business was conducted over headset screams and 4-hour lunches. Imagine a table at a high-end sushi restaurant in Mayfair. Crystal glasses, bottles of Bollinger champagne, platters of sashimi. Sitting there is a broker. Sitting across from him is a trader like Hayes. The broker wants one thing: commission. He gets paid when Hayes trades. Hayes wants one thing: information and influence. The atmosphere is thick with transactional friendship. The broker leans in. What do you need, Tom? Hayes doesn't ask for a trade. He asks for a rate. I need the 6-month yen LIBOR to drop. Can you tell your guys at the other banks that the market is softening? The transaction was explicit. It was bribery, thinly veiled as business. The chat logs recovered by the SFO, Serious Fraud Office, read like a script from a dark comedy. Broker: Mate, I can get the guys at RBS to lower their submission, but I need some flow. Hayes: Done. I'll put a wash trade through you. 50 million volume. You get the commission. Broker: Lovely. And I'm thirsty. Hayes: Bottle of Bollinger on its way. Broker: You're a legend. Consider the rate moved. This is the wash trade mechanism. Hayes would execute a pointless trade, buying and selling the same thing instantly, just to generate a commission fee for the broker. It was a legal way to transfer a bribe. The broker would then get on his voice line to the submitters at other banks. He wouldn't say, Hayes wants the rate low. He would say, the market is looking soft today, lads. I'm seeing offers come down. He would spread a false narrative. The submitters at the other banks, trusting the broker's view of the market, would lower their submissions. Hayes paid a few thousand in commissions to make $500,000 in profits. Tom Hayes was later described by prosecutors as the Spider-Man of the scandal. Picture a map of the global banking system. You have UBS, Citigroup, Deutsche Bank, JP Morgan, RBS. These are fortresses. They are supposed to be independent competitors. Hayes built a web that connected them all. He had his broker contacts whisper to the submitters at Bank A, Bank B, and Bank C. Suddenly, on a Tuesday morning, 4 different banks would all submit a rate that was 1 basis point lower. To the outside world, it looked like a market trend. Oh, the cost of borrowing yen is going down. No, it wasn't. It was coordinated action. The trimmed mean didn't discard these rates because they were clustered together. They became the centre. They became the average. Hayes had successfully gamed the statistical safeguard. He wasn't just gambling on the market, he was painting the market. And for a long time, the bank's compliance departments saw nothing. They saw a trader generating incredible profits. They didn't ask why he was spending so much on broker commissions. They just paid him his bonus. For years, this was a game of greed. It was about bonuses, sushi, and being the rainmaker. But then the sky fell. 2007 turned into 2008. The subprime mortgage market imploded. Lehman Brothers began to wobble. Suddenly the banking system wasn't swimming in cash, it was drowning in debt. Banks stopped lending to each other. Panic set in. In this new world, LIBOR stopped being just a profit lever for traders like Hayes. It became a survival signal for the banks themselves. The motivation for rigging the rate was about to shift from making money to hiding the bodies. The game changed, and the orders to manipulate were no longer coming from the traders in sweaters. They were coming from the men in the Italian suits upstairs. September 2008. Wall Street is burning. The ticker on the television shows red arrows pointing down, day after day. Inside the boardrooms of the world's biggest banks, the mood is funereal. Everyone is terrified that their bank is next. In this environment, a high LIBOR submission is a death sentence. Remember, LIBOR is the rate at which you can borrow. If you submit a high rate, say 6% when everyone else is at 4%, you are telling the world, I am risky. No one wants to lend to me unless I pay a premium. It is like walking into a hospital and shouting that you have a fever. The market sharks will smell blood. They will short your stock. They will pull their deposits. So, a new directive comes down from the executive suites. It isn't written in an email. It is a nod, a whisper, a phone call. Get our LIBOR down. We cannot look like an outlier. This phase is known as lowballing. It wasn't about trader P&L anymore. It was about reputation management.
Imagine the conversation between a senior manager and the head of the money market desk. Why is our LIBOR submission so high today? We're 10 basis points above the pack. Because that's the truth, sir. No one is lending to us. Cash is tight. I don't care about the truth. I care about the share price. If we post that number, the journalists will be all over us. Fix it. But we can't borrow at the lower rate. I didn't ask you to borrow. I asked you to submit. Put us in the pack. Make us look safe. The submitters were now under pressure not from their drinking buddies, but from their bosses. They systematically underreported their borrowing costs. They lied to make the bank look healthier than it was. And because every bank was terrified, almost every bank did it. They all lowballed together. The benchmark that measured the health of the system was completely detached from reality. This created a terrifying feedback loop. The central banks, the Fed in New York, the Bank of England in London, were watching LIBOR to gauge the crisis. They looked at the rates and thought, well, it's high, but it's not catastrophic. The banks are still lending. They were looking at a mirage. The real cost of borrowing was sky high, but the reported LIBOR was artificially suppressed. This meant that the policies designed to save the economy were based on bad data. It also meant that unsuspecting investors were being ripped off. If you were a city council or a pension fund that owned a bond paying you LIBOR plus 2%, you were getting paid based on the suppressed rate. You were receiving less interest than you should have. The banks were effectively stealing from their lenders to protect their own stock prices. The manipulation had gone from a micro heist by traders to a macro cover-up by institutions. The banks thought they were saving themselves. They thought this was necessary wartime conduct. But they forgot one thing. Electronic records are forever. While the executives were whispering in corridors, the traders and submitters were still chatting on Bloomberg terminals. They were leaving a digital trail of breadcrumbs that stretched from Tokyo to New York. And eventually, a regulator in Washington, combing through the wreckage of the financial crisis, noticed something odd. The numbers didn't match the market reality. They started asking for the emails. They started asking for the chat logs. And when they finally cracked the servers open, they didn't just find a few errors. They found a library of confessions. December 2012. The hammer drops. Tom Hayes is back in England. He has left the high-flying life of Tokyo. He is sitting in a police interview room. The walls are bland. The tape recorder is running. For the banks, the strategy was settle and survive. UBS, Barclays, RBS, they all lined up to pay fines. Massive fines. Hundreds of millions, eventually billions of dollars. But the public wanted blood. They didn't just want corporate checks, they wanted handcuffs. They wanted a villain. And Tom Hayes, with his chatty emails, his explicit requests for bribes, and his obsessive networking, was the perfect villain. He was the ringmaster. While the senior executives who ordered the lowballing largely claimed ignorance or hid behind the fog of corporate hierarchy, Hayes was exposed. He had written it all down. "I've kept it artificially high," he had typed. It was a confession signed in pixels. The trial of Tom Hayes was a window into the soul of the city. His defence was simple and terrifying. "I wasn't going rogue. I was doing my job. My bosses knew. The compliance department knew. They sent me emails congratulating me on my profits. The bank gave me a manual on how to do this." You are saying dishonesty was company policy? I am saying there was no dishonesty in my mind. Every bank did it. It was industry practice. If I didn't do it, I would have been fired for incompetence. This was the crux of the scandal. Was it a crime if everyone was doing it? The jury looked at the sushi and champagne. They looked at the wash trades. They looked at the 0.01% moves that stole millions. And they didn't see industry practice. They saw theft.
Hayes was sentenced to 14 years in prison. It was one of the harshest sentences ever handed down for a white-collar crime in the UK. He was the face of the scandal, but notice who wasn't in the cell next to him. The CEOs, the board members, the regulators who had arguably winked at the lowballing during the crisis. The system effectively cauterized the wound by cutting off the limb, Hayes, and claiming the rest of the body was healthy. The banks paid their fines, which were tax-deductible in some jurisdictions, and moved on. The narrative was established. It was a few rotten apples. But the data suggests the barrel itself was rotten. The fact that Hayes could manipulate the rate meant the rate itself was flawed. It wasn't just a failure of character, it was a failure of design. A polled metric in a for-profit world is a loaded gun left on a playground. But the story didn't end with Hayes in a cell. Years passed, legal standards shifted. In the US, convictions of other traders were overturned. Courts began to rule that if the bank could theoretically borrow at different rates, choosing the one that benefited the trader wasn't necessarily a crime. It was just ruthless capitalism. Hayes fought from prison, and then a shock. In 2024 and 2025, the legal tides turned in the UK too. The logic used to convict him was questioned. The definition of dishonesty was re-examined. The ringmaster might have been a criminal, or he might have been a scapegoat for a system that never defined the rules. But whether Hayes is guilty or innocent in the eyes of the law, the money is gone. The wealth transfer happened. The homeowners paid the higher rates. The pension funds took the losses. New York, 2023. A quiet funeral. Not for a person, but for an acronym. LIBOR is officially dead. Regulators, terrified of another scandal, have killed it. They replaced it with SOFR, Secured Overnight Financing Rate, in the US, and SONIA in the UK. These new rates are different. They are based on actual transactions, not estimates. You can't poll them, you can't nudge them with a phone call. It seems like the problem is solved. The banks have new compliance software. The chat rooms are monitored by AI that flags the word favour or champagne. The era of the cowboy trader is over. Or so they tell us. The screens in Canary Wharf still flicker. The bonuses are still paid. The hunger for that extra basis point hasn't gone away. Imagine a conversation happening today, right now, between a quant and an algorithm developer. Quant: we can't rig the rate anymore, it's transaction-based. Developer: true, but we can front-run the transactions. We can spot the liquidity gaps before the rate prints. Quant: exactly. We don't need to lie to the survey, we just need to be faster than the truth. The mechanism has changed, but the game is the same. The financial system is still a collection of asymmetries. Someone always knows more than someone else. In the LIBOR days, the edge was a friendship with a submitter. Today, the edge is a microwave tower that beams data 2 milliseconds faster than fiber optics. The method of extraction has evolved from social engineering to technological dominance. We must understand the lesson of LIBOR. It is not that bankers are greedy. That is a cliché. The lesson is that if a metric becomes a target, it ceases to be a good measure. This is Goodhart's law. LIBOR was meant to measure the market, but because so much money depended on it, it became the market. We see this everywhere. We see it in inflation data. We see it in unemployment numbers. We see it in ESG scores. Whenever trillions of dollars are indexed to a single number, the people who control that number come under immense pressure to bend it.
The LIBOR scandal was not an anomaly. It was a feature of a centralized financial system. We removed the specific vulnerability of the pole, but we have not removed the incentive to manipulate reality for profit. The next scandal won't be about interest rates. It will be about carbon credits, or crypto reserves, or AI-generated asset valuations.
So, the next time you sign a mortgage, or take out a student loan, or look at your pension statement, look at the fine print. Look for the benchmark. Ask yourself, who sets this number? How is it calculated? And who benefits if it moves 0.01%? The men who rigged LIBOR are mostly out of the game. Some went to prison, some went to their yachts. But the infrastructure they exploited, the opacity, the complexity, the reliance on trust in a trustless environment, is still the bedrock of the global economy. The heist is over, but the bank is still open, and the doors are unlocked. Don't think for a second that the rigging stopped. It just got quieter. It just got smarter. Stay watching. Stay skeptical. Because in this casino, the house doesn't just win. The house writes the rules of the game while you are playing it.